Let's get right into it. Number 7, safety buffer check. Before you invest, answer this like your rent depends on it. If your paycheck stopped for 30 days, would you be forced to sell your investments on a red day? Because that's how people get wiped. Not from picking the wrong stock, but from being forced to sell at the worst moment. Picture it: car repair, boiler dies, surprise medical bill, or your landlord bumps the rent. The market doesn't pause for real life. When prices drop, your brain screams, "Get me out," and you hit sell right before the bounce. Painful. Does the buffer test? Can you cover essentials for 1 month, housing, food, utilities, without touching your portfolio or a high-interest credit card? If not, your first investment is breathing room. If you're thinking, "I'll just sell a little if I need to," that's the slippery slope. Stress turns a little into all of it. Here's the twist: a cash buffer isn't sitting out. It's buying the power to wait. With even $500 to $1,000 set aside and a plan to build more, you stop treating the market like an emergency fund. The next check is the one that prevents investing from turning into a countdown timer. Number 6, goal and timeline check. Now, the trap that looks harmless: investing money with a deadline. Quick question: what's the exact date you'll need this cash? Next summer? In 2 years? Or whenever? If you can't answer, your brain is setting you up to panic later. Real example: you're saving for a house deposit in 12 months. You invest it because markets usually go up. Then a normal pullback hits, 15%, 20%, and suddenly your down payment turns into a moving target. You either sell at a loss or delay your life plans. That stress is what forces bad decisions. Do the one-sentence test: I'm investing dollars for, and I won't touch it until. If the timeline is under 1 to 3 years, treat it differently. Short-term money needs stability. Long-term money can handle the roller coaster. Pro move: create 2 buckets. Deadline money stays somewhere boring and accessible. Long-term money gets invested. Mixing them is how a normal dip becomes an emergency, and emergencies make you click buttons you'll regret. The market isn't risky, your timeline is. Next up is the brutal 30% drop question that exposes your real risk tolerance. Number 5, the 30% drop reality check. Let's do the test nobody wants to do. If your portfolio drops 30% next month, what happens next? Do you hold, buy more, or rage sell to stop the bleeding? Most people think they're long-term until the chart looks like a ski slope. Then your body reacts first. Tight chest, doom scrolling, refreshing your app like it owes you money. Your feed is yelling, your friends are panicking, and the headlines: CNBC, BBC, Financial Times. Pick your poison. Make it sound like the world is ending. That's when loss aversion kicks in. Your brain will pay almost any price to avoid more pain. So write this down before you invest. 3 lines. Down 10%, I will. Down 20%, I will. Down 30%, I will. And if you think, "I'd buy the dip," prove it. Decide the amount now, while you're calm. Don't let panic decide your dip budget. If the honest answer is, "I'd probably sell," that's not a character flaw. It's your real risk tolerance showing up. Adjust the plan before the market tests you. Next check: rules before feelings. Because the market's favorite trick is getting you to change your plan mid-panic. Number 4, rules before feelings check. The market's #1 mind game is getting you to rewrite your rules while you're stressed. One bad day and suddenly just this once, you're way into a mess. You change the plan, move the goalposts, and call it flexibility. Here's the scary question: if you don't have rules written down, who's actually in control? Your plan or your mood? Write 3 rules simple enough to follow when your heart's racing. How much you invest each week or month. What you do on a drop: hold, add, pause. What would make you sell? If it's not written, it's not real. Your future emotional self will come up with a very convincing story. Casinos love this principle. The house wins when you change bets mid-game. Pro move: set a plan day. You can only update rules on plan day. Never during hype, never during panic. That's how you stop impulse decisions without needing superhero willpower. Buffer plus timeline plus drop tests. plus written rules. If you've got those four, you're already ahead of most people. Next, the hype and FOMO filter, because the internet can turn investing into a trap in under 30 seconds. Number 3, hype and fear of missing out, FOMO filter. If you ever felt urgency like, I need to buy this right now, pause. That adrenaline isn't a signal, it's a warning. If nobody was posting about it today, would you still want it? Hype hijacks your social brain. A clip goes viral, your group chat starts buzzing, and suddenly you're about to buy something you can't explain in one clean sentence. And here's the kicker. The market doesn't punish beginners for being wrong. It punishes them for being late. Chasing turns you into the last person in, and often the first person to panic. Use the 24-hour rule. If you discovered the idea today, you are not allowed to buy today. Wait one full day. Then recheck 2 things. Does it fit your goal and timeline? And does it still make sense without the hype soundtrack? Want the extra filter that saves you from most bad buys? Ask, what would have to be true for this to be a terrible idea? If you can't answer, you're not investing, you're hoping. The next check is about your information diet, because if your feed is all hype or all doom, your decisions will swing to extremes. Number 2, noise and confirmation bias check. When you research an investment, are you looking for truth or looking for permission? If you only watch people who agree with you, how would you ever see the iceberg? Confirmation bias means you collect yes information and ignore no information. Then recency bias piles on. If it's been going up lately, your brain assumes it will keep going up. That combo is how people buy near peaks and call it conviction. Here's the fix, the 2-source rule. Source 1 supports your idea. Source 2 argues the opposite. And credible doesn't mean loud. Credible means someone showing numbers, disclosures, filings, or at least a clear framework, not just vibes, memes, or a hot take with dramatic music. Do this quick line in your notes. I might be wrong if, danara. Fill it with something specific. Earnings disappoint, rates stay high, competition increases, and regulation changes. If that sentence is hard to write, that's your ego trying to protect itself. And that's not a theory. You've seen it. Next is the humility check, the one that stops you from going full hero mode after a few wins. Number 1, humility check. A winning streak is when most investors start making their worst decisions. You feel unstoppable, you size up, and you start thinking the market is easy. That's the moment it usually bites back. If your last 3 buys were green, are you about to take a bigger risk just to feel that rush again? Do the humility move. Write, I could be wrong, and list 2 reasons. Not vague stuff, real reasons. The business underperforms, the economy slows, rates rise, the sector rotates, currency moves, and regulation tightens. This isn't negativity, it's insurance against blind confidence. Then set a no hero moves rule. Cap any single idea to a percentage you can live with, and don't break that cap because you're hyped. Consistency beats excitement. Confidence feels good. Consistency pays. Because the market will eventually hand you a week that tests your ego. Your rules keep you in the game long enough for compounding to do its thing. US, UK, Canada, Australia, it doesn't matter. Now screenshot this. Buffer, goal timeline, 30% drop plan, written rules, FOMO delay, 2-source research, and humility cap. That's your pre-investment checklist. If you want the printable 1-page version, comment checklist and I'll pin it. And tell me which one you've skipped before, FOMO, panic selling, or overconfidence. So which one of these 7 checks do you skip the most? Drop it in the comments, and if this checklist helped you, hit like, subscribe for more psychological videos. Thanks for watching.